Let's talk about all this now with Mike Mayo, Wells Fargo Securities head of U.S. large cap bank research. Mike, of course, the Goldman Financial Services Conference was on this week, and apparently you managed to attend, even though this would have been the first year in, what, 20?
Well, let me straighten it out. So we actually had our firm had a technology conference last week with over 185 presenters, and this week you had the big bank CEOs present at the Goldman Sachs conference. I did not attend, but you are allowed to watch the webcast over line. But this is the 20-year anniversary of when I was kicked out of the Goldman Sachs conference. What happened was I was fired for being too negative on the banks. I was unemployed. And then I got a job to attend the Goldman conference. But when I got there 20 years ago, Goldman told me that I was not allowed in, and I was escorted out over the marble floor of the Pierre Hotel in New York City. And then the person who hired me, Stan Druckenmiller, the famous hedge fund manager, made a few phone calls, got me back in. But when I went back to the conference 20 years ago, they had a security detail. And that was a Goldman employee had to follow me literally everywhere I went. So I got kicked out. I got back in. That's when I was acting as an investor. But this week I paid attention from my perch at Wells Fargo Securities.
Sounds like a regular Friday night for many investment bankers, Mike. Talk to us about what you did take away from the conference this year.
Well, I think what's important, you're seeing a snapshot today. As goes COVID and the stimulus, as goes the banks. The banks were the worst performing group until Pfizer Monday. But since Pfizer Monday, when word of the vaccine first came out November 9th, you've seen banks far outperform the general market. Now, today, with concerns about stimulus and the direction of COVID, you're seeing banks underperform a little bit. But we think the message from this week and from our conference last week at Wells Fargo Securities is that, the better times are ahead for the banks, even though worse times are still ahead for consumers, small business, and corporations. So the brunt of the pandemic on the economy is still yet to be felt. But what's different, though, and what the message from the banks is that they've set aside reserves for the problem loans that are likely ahead. In fact, they might have set aside too much in reserves for the problems based on what they're seeing so far.
Yeah, I mean, I just want to pause on that for a second, Mike, because it rarely has it been more evident. And I think the big banks, especially where they combine investment banking with the more consumer-facing side of the world, encapsulates the K-shaped recovery, the spikiness or unevenness of what we're going to see. A lot of money still being made at investment banks. How long can they hang on to their margins, despite the fact that that piece of the business, the capital markets world, is doing just fine? At what point will pressure start to come to bear?
Well, I think one point that's really underappreciated by the general population is the nature of bank products when serving corporations. Bank loans are substitute goods for capital markets like bonds and equities. And so earlier back in March, you saw banks step in with their balance sheet, get aggressive with lending, helping to act as part of the solution and building a bridge from the pre to the post-pandemic economy. Then with government stimulus efforts, the capital markets opened up, amazingly so, and that's why you've seen such strong activity. And what you learned this week is while traditional banking revenues of banks remain under pressure, you're seeing the capital markets revenues, the trading revenues, up 10 to 20% year over year in the fourth quarter for banks like Citigroup, Bank of America, and JP Morgan.
I've got to ask you, Mike, I don't know if you're going to want to answer, but we did get, of course, a settlement from Gary Cohn on IMDb. I'm just curious for your take on how that unfolded and whether, in the end, the right things came to pass.
Well, look, the nature of clawbacks are that you claw back. And so, I've certainly been focused on Citigroup to some degree with the new consent order and whether or not they should claw back pay based on a situation that's been created over the past several years. So, top bank executives need to be held accountable. And as you know, Bonnie and Amanda, I attend annual meetings in person, not this year, but when allowed. And I always ask a question about compensation and what's the rationale for a lot of the high pay for the likes of Citigroup in particular when you look at over the last 20 years. But it's entirely appropriate to claw back and investors should better hold bank managements accountable And if investors don't do it, then it creates a void for Washington, D.C. to step in. And I think capitalism, demands investors do so.